Okay, continuing with taxes, we're going to talk about marginal tax rate. The book, the it's also referred to as the tax bracket. Other than the book, I've never heard of anybody refer to it as the marginal tax bracket. So I strike that. But so it is referred to as the marginal tax rate, which is the rate at which your last dollar of income is taxed. So can also refer to it as the rate at which your next dollar of income would be taxed. So for most people, unless you're on one of the boundaries, that would be the same rate. Um, Indexing. So indexing adjusts the tax brackets each year for inflation. When we get to I'll give you an idea of how that works. But basically, their tax brackets are adjusted by the CPI or Consumer Price Index, and the that wasn't always the case. I believe I believe Ronald Reagan uh, created created the term called bracket creep, which refers to when your income goes up as a result of inflation, as opposed to um, as, as opposed to actually growing, and you end up in a higher tax bracket as a result. So that's so the this is an old federal income tax uh, uh, tax rate schedule. So the new ones look very much the same. We have our tax rates over here, and then our boundaries. So in this case, so up to $9,075, the well, you would pay a 10% tax, and then over that, it would be and you would pay 15% on the amount between 9,075 and 36,900, and so on. Previously, our highest tax rate was 39.6%. The in the new tax law, or the 2018 revisions, that's 37%. That schedule is actually on the next page. I'm going to show you a couple of calculations. Uh, there are multiple tables. I've actually posted a sheet from Putnam that they produce annually that has all sorts of tax information. It has the the tax rate schedules for 2019 on there. But anyway, and on this one, the 9,000 up to $9,525 for would be taxed at a 10% rate. So $9,525 times 10% is 952.50. So this 952.50 is the amount of tax up to the bottom of the bracket there. So, and then if we go to the next bracket, the $38,700 is the bottom of that bracket. So $4,453.50 is the bottom of that bracket. So example here. So, and this, just so you know, this would be uh, referred to as unmarried individuals. That's historically has been referred to as single. The you know, the Congress and the IRS likes to change things up just to confuse people. So, but anyway, so we're going to do two examples. One is um, 50,000 of taxable income. So if you earn $50,000, that means that you're going to be into $50,000 falls between 38,700 and 82,500. So your marginal tax rate is going to be 22%. So your tax liability is that $4,453.50 plus 22% or 0.22 of the amount over the 38,700. So we take the 50,000 and we subtract 38,700, and that is $6,938.50. Okay. So in a second, we're going to do the average tax rate for both of these calculations. If this were a married couple that were filing jointly, we would use that married filing jointly table, and we would combine their taxable income to determine the tax liability. So next example is so we have a $100,000 taxable income. So the tax liability here, I'm going to work down the side of the page, is so we're gonna be in the 24% tax bracket here. We jump brackets, so because we're above 82,500 and less than 157,500. So the tax liability is the $14,089.50 plus the 24% of the difference here. So 100,000 minus the 24% times 100,000 minus the 82,500, and that gives us a tax liability of $18,289.50. So the so so first person here is got a 22% marginal tax rate. Second one, a 24% marginal tax rate. Average tax rate. So for the first one, that would be the $6,938.50 divided by the 50,000. So that is I think 0.1388 or 13.88%. So considerably lower than the 22% marginal tax rate. The second one is going to be that one's actually, we can actually eyeball that, but it's 18,289.50 divided by the 100,000, and that is 0.1829 or 18.29%. So that's a perfect example of the progressive nature of the federal income tax system.